you should be doing to protect yourself and prepare for that next downfall. And those are some of the things that we're going to be talking about today. So one of the first things I'd like to start with is micro versus macro. And what I mean by that is you've got the real estate cycle and the real estate market as a whole. And when I say as a whole, that could be the entire, earth, from across one side of the world to the other. But overall, when we're talking about the macro level, let's just talk about, let's say, the United States. Overall, what does the real estate market look like for the United States? But boiling it down from there, everybody knows that the market is not the same in every single part of the United States. California, New York, Florida are really big ones that tend to boom a little faster and bust a little faster. But then you've got like Iowa and Idaho and North Dakota. Their markets tend to kind of stay around where they're at or do their own little things. So if you're looking for this as an investment, always try to look at your specific area, like Dallas, Fort Worth, Houston, what do they call that? The Texas Triangle, where you got Houston, Austin, San Antonio, DFW kind of makes a triangle. It's called the Texaplex. Our specific real estate market is totally different than those across the United States as far as I'm concerned.
Right.
Because we have different factors driving our economy. So if you're wanting to look, and you don't want to just go out and read some post on the internet talking about the real estate market, you need to look at your specific backyard.
Well, yeah, because again, you got to understand what's the driving force behind your market. Like Dallas, back in the day, used to be oil and cattle. Nowadays, it's a mixture of everything, and that's why Dallas-Fort Worth market is so stable. And I say stable because, it's a very loose term, but for the most part, it is stable. Because even when the crash, we were one of the least affected. But then you've got places like Detroit that's so heavily dependent on, I think it's Detroit, the automakers.
On the auto industry.
But then you've got those different or a coal miner town or like Pennsylvania, you got a lot of steel towns. So when you have areas, metroplexes, cities that are just married to one industry,
keep a beat on it.
Yeah, you need to make sure. Hell, Houston, oil, hurricane hits. Oh shit. But Dallas is lucky because we have tech, we have oil, we have this, we have that. So,
there's a lot of things driving our economy. So with that to be said, just pay attention to your specific area and what's driving your economy and what's the real estate market doing based on that. But real estate comes in trends. There was an economist back in I think it was an economist, I don't really remember. I'm not going to pretend like I'm an expert here. But back in the 1930s or so, he pretty much started predicting an 18-year market cycle. Some people disagree with the 18-year market cycle, but for the most part, for the last 100 years or so, it's remained true outside of a small dip during, I believe it was World War II. Outside of that, other people argue a 7 or 8 year market cycle. You see different cycles coming through. All of that to be said, a lot of people are saying we're like 9 years into a 7-year cycle right now.
Right, but keep in mind, back to the whole beginning of this with Mark Cuban, or we think it was Mark Cuban, that everybody's genius in a bull, in the bull market.
What I would like to stress, though, is you have different real estate investing strategies that perform better depending on what market you're in. Are you in an early downturn? Are you in a full downturn? Have you hit the bottom? Are you in recovery? Are you stable? Are you in hyper? What market are you in? And depending upon what market you're in, depends on what real estate investing strategy you should be doing. I'm going to go ahead and start with, I guess, the turn of the peak. You've kind of hit the full-blown top. You're right out there at the peak of the market. All the way up to the peak, you should be constantly, at the very least yearly, doing stress tests on your portfolio, looking at what's going on within your portfolio. How would, a drop in rents, if rents dropped 10, 15, 20%, how is that going to affect my debt service coverage? How is that going to affect my net operating income? How is that going to affect everything that I'm currently holding in my portfolio?
Right.
If rents take a huge dive, am I going to be able to support that? And what you might find is that your whole portfolio might be able to handle it, but specific assets within your portfolio may not be able to handle that.
Right.
And those specific assets, you need to take a look at those, and while you're on that upward trend, you either need to power the debt down so that way it can handle going through a turn in the market, or sell it.
So for us non-smart people, when you say power the debt down, what exactly are you referring to?
All that cash flow you're bringing in from your portfolio, instead of using that to do whatever you're going to do with it, if that specific asset in your portfolio, you want to keep it, but it doesn't pass the stress test, you need to modify it somehow, whether that be take your cash flow and pay down the debt, on that specific asset, so that way if in a downturn you're not stuck in a bad position or you need to sell it. So as you're going through the recovery phase and you're going through the, getting towards the peak, throughout this entire time, you need to be taking a look at your entire portfolio and determining what are your weakest assets. What are the ones that are causing you the most problems, or which are the ones that you just don't want to deal with anymore? Let's say you have a really big portfolio that's all in one specific county, and you've got 2 or 3 that are in a different county that's causing you some headaches, or you're really getting tired of them. The best time to sell those is always at the peak, but it's not always possible to time the market. So, but if you can tell that you're on an upward swing and you're hitting close to, seeing where your demand is greater than your supply, and that's really been trending for a while, you might ought to start looking at thinning out your portfolio a little bit, and or using the time of growth to power down and get rid of some of the debt under some of your properties.
Can I throw out a Captain Obvious moment?
Yeah.
So Captain Obvious, obvious idea here is, this is why it's so important to buy deep, buy at a discount. I know a lot of landlord type investors, they can buy at retail because they're looking for the cash flow, but if you buy deep enough, whether you over or underestimate the rehab, or you have a 10-15% dip in rents, if you bought deep enough, you can withstand all that. So, I know that's just blaringly obvious, but I just felt the need to point that out.
I agree and I disagree, and I agree wholeheartedly with everything you said, but what I disagree is the common sense aspect of it, because that is what causes so much of the trouble that we've seen in our cycles, is we have uneducated people joining into the real estate investing saying, oh, I watched HGTV and I'm about to make myself millions, and they go out and buy rental properties with negative equity, cash flowing $10 a month. And they're like, oh, the market's gonna go up, and that is what causes so much of the trouble that we see. That's why in 2008 and in 1989, you saw a whole lot of people just doing stupid stuff, and that was because they were not educated investors. They did not understand the market. They just saw everybody on TV doing really good with real estate and decided to jump in on it. And I think that causes a lot of problems. But all that to be said, just what Ryan said, you need to be buying with discounts. The reason historically everybody said 70 cents on the dollar minus repairs, because that's a safe number. You start going in and you buy it at 95 cents on the dollar, and you're not an extremely educated person that knows exactly what's going on in the market, you're in for a ride.
And I'm gonna, if you don't mind, tangent real quick, just because again, the common sense thing kind of peaked something we've been dealing with the past couple days. Not dealing with, but Jason McDougal had a house, a couple months ago, that he did a live video, and it was just disaster. I'll do a link to it later. Anyway, he's like, I ain't no how nothing gonna make an offer on this property. Daniel and I were like,
I'll buy it.
We'll do it. So to keep in mind, this property was overflowing with trash. It was literally trash into the streets. It literally looks like a nuclear bomb had gone off, and it was just disaster. So we offered $12,000 cash and a couple of other options with financing, but essentially it's $12,000 cash. So they're like, we're thinking about it. Anyway, I got an email last week. I don't know if I've told you this yet. But hey, we cleaned up the yard and we tore down the house, and now it's a vacant lot. What's your offer?
$1. They completely
$1,000? Yeah, because
But they didn't understand the real estate game, so they started trying to play real estate, and they just lost probably 15 grand.
Right, because they probably spent $5,000 to $8,000 to clean up and demo the house, and no one's in that area. They probably thought, oh, I could sell the lot for $30,000, $40,000. That ain't happening. Now literally maybe $500, maybe $1,000 for the lot. And so not only are they out, but they're out big. And again, it goes back to that point of know your market, know the analysis, know the numbers. And real estate is not very forgiving if you really blow it. So I just want to throw that out there because you were talking about the common sense aspect of it.
So going back to the cycles and trends, we're starting out at the peak, and we're going to go through different timing in the cycle and what strategies are best to use in those specific times. I would say as you're approaching the peak or getting to the peak, you need to be doing stress tests on your portfolio, finding out which assets are not going to make it through a downturn, and which assets you're just tired of dealing with or want to cash out, because liquidity is king when you hit the peak. As you start getting to the peak, you need to be in time for capital reserves. You need to have money backing you, whether that's private money or access to money, because as the market shifts, credit dries up. It starts getting difficult to find credit. It starts becoming a problem for you to obtain. So cash is king whenever you hit that downturn, and you need to be prepared for that. But while you are approaching the peak, that is the perfect time to be moving through flips in and out of the market as fast as you can. And I say when you're closer to the peak, you need to be moving through these flips as fast as possible. Don't go for these risky ones, where you're outside of the norm. Let's say you have a pocket in your specific market that says, properties between 150 to 250,000 sell the fastest and the easiest. While you're at the peak or near the peak, that is a good opportunity where you can come in and you can start turning those, get it in and out of them extremely fast. Don't try picking up some awkward assets at that point in time, stuff like way outside of the market, like multi-million dollar new construction projects that have limited buyers for them. And those are going to be the ones that get hit the hardest and the fastest whenever the market turns. So you don't want to be playing with that asset class whenever that market starts hitting there. But as you start approaching the peak, some things that you'll see a lot of is a lot of new construction going on, a lot of rehabs going on. And I don't personally think that rentals are the best things to be trying to acquire at the peak. That is, in my opinion, one of the stupidest things you can do.
It should be offloading.
You should be offloading and culling your rental portfolio when you start approaching the peak, because acquiring at the peak means you bought at the high, and you're probably going to freak out whenever the market turns and you're going to sell low.
So I know this, maybe this is not this video, but how do you identify a peak?
That is very subjective, but there are some things you can look at that will help you analyze. And I'm not a big data guy. You probably know this as well. But looking at your average days on market over the past several years, look at year over year. Are my days on market going small? Are they going? Are they decreasing or are they increasing? What's my inventory look like? That's another really good indicator. Like if you're in a oversupply, you've got more properties out there, your inventory is going to be huge. I'm going to be showing 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months of inventory. That's going to depend on your specific market. But if inventory is drastically increasing, that's going to indicate that you're moving into a buyer's market. But whenever you start seeing your inventory meaning the number of houses available on the market, how long would it take based on the days on market for those to sell off? Looking at the inventory, if I have very little inventory, then I'm obviously in a seller's market. So you need to keep an eye on some of those things. Other things to look at as a landlord is your occupancy averages and stuff along those lines, and how many foreclosures are hitting the market. As you start seeing foreclosures tick up, you start seeing occupancy decrease, you start seeing inventory increase and days on market increase. Things like that are indicators that something's changing in the market.
Right.
I obviously all turn towards the shift on the downside, but same thing on the upside. If you have a whole lot of inventory, you're starting to see that inventory shrink, you're starting to see occupancy rates go up, you're starting to see foreclosures decline, you're probably on a upwards trend.
Yeah, I'm glad you said that it was subjective, because I know about 4 or 5 years ago, the group that I was running with, like literally 4 or 5 years ago, they said, in 18 months, we're probably gonna have another crash. 4 or 5 years later, we're still doing this. So again, it's completely subjective, and I think ultimately it comes down to your risk tolerance. Don't throw money at something that, if it does turn, is going to wipe you out.
So, good point. Looking there at the peak, though, that's the point in time where you should probably be culling out your herd, trying to move into a cash position, getting rid of the properties that you don't plan on holding for another 10 years, because it might be 10 years before you start to hit that boom again. But get rid of everything in your portfolio that you're not wanting to deal with, that you can liquidate and hold as cash, because whenever it turns, that's going to be your opportunity. And whenever it does turn, credit becomes difficult to get. So as it's turning, there's things that we should take into consideration there. And there are specific strategies that tend to thrive in a downward pushed market. And that would be owner financing strategies like subject to, straight owner finance, wraps, things like that, as well as short sales. If you do not know what those are, check out some of our other videos where we discuss those types of things. Go out and check out the Academy when we get it released. We'll be teaching those specific strategies as well. But subject to is great in a downward moving market, because what you're going to have is a lot of people that bought at the peak. Things have shifted, they can no longer afford it. And I have to preface this, on the downward moving market, you don't want to move, you don't want to jump in right at the middle. You need to kind of be paying attention to what's going on and wait till you hit towards the bottom. And when you hit towards the bottom, that's going to be the absolute best time. That's when you're going to get your best deals. But whenever the market is moving down, you can still do shorts. being, get the bank to sell it to you for less than what they paid for it. You can do subject to, which is great because as the credit starts drying up, so does the opportunity to buy. And there are still people out there in a downward moving market that want to buy a house and they're having problems getting loans. So using subject to acquire some of those, as long as the deal still makes sense, you can take over property subject to in a downward market and or short them. Shorts, owner finance, wraps, and I think that is what you should be doing in a downward moving market so that we can add some properties to your portfolio. And as you add those to your portfolio, hopefully you caught them towards the bottom so you can catch the next wave up. But once you do hit the bottom, I do believe at the bottom, your best absolute strategy at the bottom is rentals. You want to get as many rentals as you possibly can at the bottom, because what you're going to be able to do is you're going to take on some compounding benefits at the bottom. If you buy a trashed out foreclosure at the bottom, I'm not going to say go through and do a full-blown rehab on it, but get that thing clean enough that you're not going to have to worry about it. Get some people moved in there. And let's say you bought it at 100 grand at the bottom of the market and you start seeing, 5-6% in appreciation over the next 4 or 5 years for that one property. Times 10 properties, you're sitting on $500,000 to $1 million just on 10 to 20 houses that you're going to appreciate through on the upward swing of that market cycle.
And then at the top, because I know before we talked about liquidating, get rid of them, not all of them, but you could either just cash out or you keep them for I guess it just depends on what your goals are in your life. But if you think there's another crash coming, or not a crash, but a downward cycle, and you can liquidate and then double your money plus all the rents you got, well,
that's the point to it.
In theory, you should be able to buy double the amount of rentals the next time there's a downward slope.
That's the whole point to it.
Or you lost your entire portfolio and you go put it all on black at the roulette table.
Well, that's the problem, is so many people are not aware of cycles, and outside of just cycles, a lot of people are unaware of the different strategies. They're just like, well, I'm a short sale superstar. Well, that's great if it's 2009, 10, 11, and 12. That's great if you love short sales. But what happens whenever 13, 14, and 15 pick up? Short sales start drying up a little bit. Your ability to get in there and effectively execute on them starts drying up a little bit. And now all you know is short sales and you've lost everything. Or what if you're a builder or a rehabber and you know nothing about how to work in a bear market, and you're sitting there in a bull market and you're rehabbing and you're flipping, you're doing great and you've made tons of money, but now you're sitting on 17 different projects, most of them new construction, with a large amount of leverage against them, speculating for the demand in the future, and then boom, the market shifts, and now all you are is a builder or rehabber that knows nothing about all the rest of these strategies, and you're stuck.
Yeah, I would highly suggest that anybody out there, whatever your education level, whatever your background in education is, find a community college and take a basic economics course. And the reason I say that is because all Daniel's talking about is basic supply and demand. And you can apply that to pretty much anything within the scope of real estate, whether we're talking about the demand of rentals or the demand of houses. But if you can understand that. Sorry, go ahead.
I'd like to pause on that for just a second, because you mentioned something that's important to realize, and that is the housing market, even inside of a micro territory, like let's say DFW, you might see different trends across different asset classes.
Right.
Rentals might be booming. New construction might be booming. Apartments might be booming. So you have different asset classes that actually probably move at different trend levels. Apartments might move at a different rate than single family housing. Single family housing might move at a different rate than other stuff. And rentals might be moving completely different than home ownership. So while home ownership is going on a rise, you might see rentals dropping.
Right.
So you need to, if you're specifically looking in different markets at different niches, you need to pay attention to what niche you're looking at, because it might be in a specific market cycle itself.
Absolutely. So. I know Austin Good had a quick question over here. He said, which MSA do you think we should move to for multifamily?
I am not a big multifamily investor. I do have some commercial properties, and I do look into buying more commercial properties, but I'm unfamiliar with the MSA term. So if you can tell me what you mean by MSA, I might be able to give an opinion on that, but I'm not the biggest, baddest commercial investor that ever hit the town. So
there you go, Austin. We don't know everything.
Hey, I'm completely okay with telling everybody I'm stupid. That means people's expectations of me are far less than what they might want it to be, and that makes it easier for me to impress people.
Daniel Vera had a quick question. I'm assuming, like, when we're talking about the the markets, this market cycle, when would not be a good deal for subject to?
I'm not going to say that there's ever a not a good time for any specific strategy, because you can use any specific strategy in any market cycles. It's just different market cycles tend to way better on different strategies. Like, so right now we are in a boom. Subject to might be a little more difficult to gain access to. So if I'm strictly a subject to investor, my volume of deals have gone down over the past couple of years. But if I'm a rehabber, or I'm a flipper, or I'm something along those lines, or a new construction kind of guy, over the past several years, I'm probably booming in those areas. So subject to can be used anytime. Any specific strategy can be used anytime. There's just different cycles that it works best in because your opportunities are increasing.
MSA stands for metro area. There we go. Thanks, Austin.
Ooh. I cannot speak specifically on that, but somebody I could recommend you to. I'll send you a private message, or if you send me a private message, I can send you somebody that would probably give you some good feedback on that, because I believe he has studied it quite extensively, and I do know where he might be moving. So I'll give you some of his background if you remember me to. Metropolitan statistical area. I can't even say the word.
Statistical? That's always my fun word too.
So what I'll do for you, Austin, is if you remind me afterwards, send me a private message and I'll hook you up with somebody that I think can answer that question for you far better than I ever would. So going back into the market cycles, we've talked about the peaks, some of the things you should be doing at the peak, such as culling out your herd, moving into cash positions, getting ready for a downturn, because whenever the turn does move, your credit's gonna dry up. Banks are not gonna be lending like what they used to, and if you are able to get a loan, it's probably not going to be on terms that you want. So we've moved through that. We're going into a downward turn. On downward turns, short sales and subject to are king, because credit's drying up, properties are falling in value, foreclosures are going through the roof. That's an opportunity to take shorts and take subject to. And then as you hit the bottom, when you hit the bottom, and that's going to be probably shown through, as you hit the bottom, demand starts going up, you start seeing a shrinkage of supply, days on market start dropping a little bit based upon what they had been doing. Once you start seeing a little bit of stability in the market, and if you have to sit on the sidelines for a year, okay, sit on the sidelines for a year. Take nothing other than clearly good deals during that time, because you don't want to be motivated by the two things that drive most markets, and that is greed and fear. You start getting greedy or you start getting fearful, that's whenever you start having problems. You need to somewhat be an unemotional investor, and those are the ones that are going to be the best. Yeah, I'm at the top of the market. Well, fear might at the top of the market tell me, well, what if I miss a year or two? What if I'm not timing this right and I miss, a couple $100,000 in appreciation that I might be able to get out of my portfolio? That's fear talking to you. Greed might be the person telling you, I need to sell now, I need to sell now, I need to sell now, because what happens, in X, Y, Z. Don't let the greed and fear control your emotions. Look at the statistics, look at the data, and then try and base your decisions on that.
Basically, know your numbers.
It is important. Real estate and investing in general is a numbers game.
That was my call to pretty much every other video we've done. And then the camera angles missed my shitty little... Anyway, sorry. I didn't mean to kill the mood.
So yeah, we're moving through. We're at the bottom. If you have cash and or private money, the bottom is where you will make the absolute most money. There is no more money made than when you hit the bottom. Yes, a bull run is great. You can do a lot of rehabs, a lot of flipping, and a lot of new construction. Yes, you can make a lot of money through that time, but it's not really the benefit of the compounding growth that you're going to get if you buy a rental portfolio at the bottom of the market. Just get it cleaned up enough that it's a stable rental. It's not, it's safe, clean, and affordable. Ride that thing out until you hit close to the next peak, getting into that early stabilization versus hyper supply. You move into that area, that is where you should start taking your rentals that you picked up during the downturn and then doing retail rated remodels on them. On the ones that you're looking to get rid of, because this is where you're going to be able to turn your equity position into a cash position on this upward trend. And if you do that, you're going to position yourself towards the peak with a large capital reserve that's going to allow you to feed again on the next downturn. I don't know if people are understanding this or if I'm making sense, but as you hit the peak, I'm going to repeat it one more time because I think it's important. As you hit the peak, you need to be doing stress tests on your portfolio, removing any assets out of your portfolio that you're not wanting to deal with. moving those into cash positions and or clearing out your portfolio into a cash position. Wait until the next downturn. You might be able to time this close. You might not hit the timing just right, but don't become a motivated buyer that says I have to be in the market. That gets you in trouble. That gets you into an '08 where people are filing bankruptcies and going underwater. Make sure that you're ready for that, and then whenever it does turn, short sales, sub 2 all day long, hit the bottom, grab up a bunch of rentals, and then once you've hit the bottom, you're going to start hitting a point of early stabilization where you're starting to see an upwards trend, an upwards turn, and then you start moving into the other side of the early stabilization, which is going to be your hyper supply. During that time, that's where you should be offloading your rentals and buying more rehabs and moving into capitalization phase. You need to capitalize on the rise, and then you need, as you're going down, to acquire more assets.
So if you're liking what you're seeing, please give us some likes, please give us some shares. Eventually, I think we need to be in every single real estate investor group in the country, in the world, but we can't do that because Facebook doesn't like us. But you can help us. If you've never checked out Propelio, check out Propelio.com. We've got all your basic essential needs, tools you need to be a real estate investor. You got comps, we got off-market leads, and then we're beta testing our websites, and we have lead management software tools. So check out Propelio.com. Real quick, going back to what we're talking about here. Oh, but again, like and share. Stress testing.
Okay.
Like, I know what that means, you know what that means, probably 99% of the people out there know what that means, but for that 1% that doesn't know what that means, what is stress testing?
It's the same across anything. I'm not just outside of real estate. It's essentially going through and doing what is the most probable things that could happen that would affect my portfolio, and if those things occur, how am I going to be able to handle it? So let's say if I'm doing rentals, what happens if my rents drop? What type of underlying loan do I have on my rental? Is it fixed rate 30-year mortgage? Well, then you don't really have to worry about an interest changing. But what if I have, a five-year note on a 30-year AM, and at the end of 5 years I'm going to have to refi out of that thing? Or what if during the end of 5 years my interest rates change? What happens if those kinds of things happen? Well, if my rents drop and my payments go up, is my portfolio going to be able to handle that? Will my reserves be able to handle that? Will I be able to handle that? And if I don't have the capital reserves to handle that, and I don't move my portfolio and shift my portfolio to handle a shift like that, then what happens whenever you hit a 2008 again, you're in a position where you weren't prepared, you weren't running your stuff right, and you're stuck. So that's what I mean by a stress test. Go through and imagine, let's say I have a bunch of vacancies occur at once. If things start moving, economic downtrends occur, people start losing their jobs. What happens if I go 20% vacant on my portfolio? Am I going to be able to handle that? Am I going to be able to handle a 20% vacancy on my portfolio with a 15% decrease in rent rates and a 3% change in my debt service?
And then also, going back to knowing your market, say you have a strong rental portfolio in a auto industry town, and everybody gets laid off, and all of a sudden your entire rental portfolio, they're still living there, but they can't pay rent. That's
some of the things you need to take into consideration, and that's kind of what do they call that? The black swan moment, where if you have if your entire portfolio is in an area,
fuck it, I'm out.
I mean, to a point, if your entire portfolio is based on in a specific industry, let's say I invest in military towns. Everybody knows that military towns boom whenever Republicans are in office and they pull back and Democrats are in office. If I'm invested heavily in one of those markets, I should probably be paying attention to the political environment, because that shift in the political environment might say that my rental portfolio is probably not in the best area right now.
Yeah, because God forbid they close down a base,
boom,
you're wiped out.
I'm done. So that might not be the smartest thing for you. But if you're investing in a military town, you need to pay attention to those kinds of things. If you're investing in an auto industry market like Detroit, I mean, there's probably some people up front that would have said, hey, Detroit's going to bust. But for the average person, we didn't know that. So if you are invested in something like a Detroit, you need to pay attention to the industry around you and keep a good thumb on what's going on with it.
It looks like Sean Burke, who's a frequent watcher, has a question. He's like, if you're doing owner financing and refinancing into rentals, how does the market affect you? For instance, if there is a crash, are you shit out of luck?
That goes back to the stress test. what could happen in a crash? What might occur? Will my vacancies go up? Will my rents go down? Or my income go down? Like if you have it on a note, technically it's not supposed to go anywhere, but if there's an economic hiccup and your person that's on that note can no longer afford the note, you now have acquired yourself a foreclosure. So there are things, and it's hard for me to see the question from over here, but if you're doing owner financing and refinancing into rentals, how does the market affect you? It really depends. If you sell, it's hard for me to give a straight answer to that because there's too many variables to just blanketly give an answer to that. You need to run what I would call the stress test. And that's going to be throw all this bullshit at it, and how do I still feel about owning that asset? And you're going to need to figure that out.
Yeah, and Daniel Oliveira, he has a question. He was asking about, because he was asking about sub-twos earlier, if a house was refinanced 2 years ago and needs about $12,000 in work, I think again it goes back to it's hard to say.
There's no way I can sit here and accurately tell anybody exactly what they need to be doing. I'm trying to give you, and the reason I can't do that is because there's too many details that need to be asked. So too many details that need to be looked at. If I was holding,
it goes back to like what we always said about comps. It depends.
It really does. There's really no rules in real estate outside of one that I can think of, and that's don't lose money. I mean, outside of that, there's a million different ways to skin a cat, and real estate's no different. Right. I mean, I've seen people make millions of dollars doing one specific strategy in a specific market, and they paid attention to it, and they backed out whenever they needed to back out. You don't have to be a well-rounded investor. You don't have to have rentals. You don't have to have commercial. You don't have to have rehabs. You don't have to have new construction and notes. All you need to have is a really good specialty and understand when and why you should apply it and when to get the heck out of it.
And excellent work ethic.
It really does make a difference.
I know it looks like you have a few more points on this that you wanted to get to.
Let me see here. Excuse me if I'm not looking at the camera. I got some notes over here on a whiteboard.
Fear and greed, and then after that, no equilibrium.
There are some benefits, like on the downward market. There are things you need to be doing to try and compound your capital so you can continue watching it grow. And if you pick up a huge rental portfolio on the downturn, and on the upswing, instead of cashing all of that out, obviously you're gonna have, there's been a lot of changes in the tax laws here in the past couple of months, but 1031 exchanges, use 1031 exchanges to reduce your taxable liability and keep that money in place so you can keep moving forward. Use 1031 exchanges to roll up possibly that rental portfolio, and if you're keeping an eye on the multifamily side of it, as the foreclosures in the single family market start to hit real hard, rental rates inside of multifamily tend to go up. So right there, whenever you have a housing bust on the single family side, the multifamily side is where that really starts kicking off. That's where that starts starting to boom. So, if you can take all your rentals, this is just all overarching, broad thought process and ideas. And the whole reason we're having this topic is somebody sent me a private message and said something along the lines of, hey, what do you suggest for a full-time investor to do and prepare for a change in the market? Well, I'm trying to throw out some ideas for you. Throw out some not so much common sense, but general education type of stuff that you can think about. And what you need to do is, after I've expressed all this to you, start thinking about what you have in your portfolio and how well prepared are you for if we start seeing a shift. Yeah,
and again, identifying shifts, again, it goes back to being subjective and it's hard to tell. But like if you've got a potential subject property to look at and you run your comps on it, and this might be going into comps, but it may also give you an indication of the market cycle in that area. If I go over there and I'm like, there's 73 houses, they're all for sale, and there's only one sold.
There's a lot of inventory and not a lot of demand.
Yeah, so that right there gives you a little micro, feeler out for what the market is in that neighborhood.
And I do that because like we're talking about macro and micro markets. Macro, let's say United States, micro being DFW, but even inside of that, there is sub-markets like in subdivisions.
Right.
You may even see this whenever I'm analyzing a property for a flip. I look at that specific sub-market, being that subdivision or whatever that it might be, and I look at supply and demand within inside of that market itself. There's been more than once where we've looked at a property and was like, yeah, you know what? That property is probably worth $200,000, but I'm competing against a large amount of supply there, and it doesn't appear that there's any demand. I'm seeing high days on market, I'm seeing lots of inventory, and I'm not seeing any volume of stuff moving over there, so no, I'm not going to rehab over there.
We did that like a couple weeks ago with your Purdue house. Like when his new build from a couple years ago, bought it for 300, sold it for 1.4 or whatever. But now in that neighborhood, there's like 17 $1 million homes all for sale, and they all have 60 plus days on market.
Yeah, and they're not moving. And that's because there's more supply than there is demand in that neighborhood. I was fortunate enough that I was able to time the market correctly. I got in before all that inventory hit the market, completed my project before the rest of the inventory hit the market, so I was able to get in and out of it.
And I think you might have missed the absolute peak that you could sold on, because I think it was like 1.7 or something like that. Or
I probably missed about 150 in profit.
But
I
at the end of the day,
you're
you're not stuck with a house for several months sitting there.
Not even months. I mean, that could be years.
Yeah.
I mean, like right now, if we're at a point in time where the supply is far greater than demand, and then we start seeing things tick back a little bit, where obviously you start seeing builders start taking price reductions. That's when things start getting a little scary.
And again, you might be going, what does this have to do with market cycles? But these are just indicators of what that overall market in that area could be.
But what I'm going back to is, if I've got a builder in that area, this isn't just multi-million-dollar new homes. This is like KB Homes. This is your Fox and Jacobs. This is your developers. Well, they put bunches of product out there on the market, and they're speculating to, let's say, sell it for 150 grand. Well, that's great. And then they put all that supply out there on the market, and then 6 months later, they're not moving it. And they've got debt service that needs to be covered. They've got loans that need to be covered. So now they start taking a price reduction. And then they take another price reduction. And then they finally sell one. And now they start moving into that, oops. And then they have to start, and then what you start happening is you start seeing people default on loans because they're not able to sell their inventory. You start seeing prices drop, which hurts the overall return of the portfolio. And then when you start seeing those start happening, that's whenever things just go whoop.
And I don't think we're here to create fear and keep you out of the market, but it goes back to be knowledgeable and have that stress test in place to understand if that shit did happen, what do you do? How are you going to survive?
I think that's the biggest point of what we're trying to say here, and then try and explain to you that there are different market cycles and different strategies work different in different cycles. Do not be a one-trick pony doing nothing but rehabs unless you are well aware of the market and know when to enter and exit it. Don't be the stupid ass that's sitting there with $30 million in loans, or $10 million in loans, or $5 million in loans, or even $100,000 in loans whenever the market shifts, because if you don't know what to do, you're in trouble.
Right.
Cool. Other things to think about though is whenever you start reaching a peak, or anytime you buy a property, you should always consider multiple different exit strategies. Almost do a pre-stress test before you buy it. And if you are wise enough to kind of do a pre-stress test before you buy it, then you know that regardless of what the market does, you should have an alternate exit strategy, like with Purdue.
Right.
With Purdue, I was well aware of where we were at in the market. I knew what I anticipated to occur, but there's no way to accurately predict. I can say X, Y, and Z, but there's no way. There's no definitive for sure way. You can have some very sophisticated people take the right guess, but for everyone that says yes, you'll have 10 more that say no.
Right.
So all of that to be said, if Purdue didn't work out like I wanted it to, what I intended to do with Purdue is new construction project, build it, sell it. What happens if I got caught in the downturn of the market? Now I'm stuck with a house that's, 5 bedrooms, 5,300 square foot in a downward moving market.
Insurance fraud?
That is exit strategy number 13. But
No, just kidding. Just kidding. Just kidding.
But what I do say is I was well aware of what was going on there, and the property was set up in such a way that adding a elevator wouldn't have been that big of an issue. And if I got stuck in a bad market and I had to hold on to that thing for 4 or 5 years, it would have turned into an assisted living center. That's exactly what would have happened to it. It had a lot of square footage. It was very nice, nicer side of the town. If I got stuck building that thing and I couldn't get rid of it, then what I'd end up doing is ultimately turning it into an assisted living center, because guess what is on an upward trend right now?
Dead people?
Old people.
I mean, people preparing for death.
I try not to house dead people, but elderly people are on a rise right now. We've got a lot of baby boomers. We've got a lot of those people coming through. We've got a lot of that. So there's a lot of people hitting retirement and or hitting that assisted living stage right now. So that is a specific underlying product that does see a lot of demand right now. And even in a downward cycle, you still got insurance companies paying for assisted living. You've still got, elderly couples that need to pay for assisted living. There's a lot of benefit there. So know your exit strategies. My intended exit strategy was turn around and flip it, build it and sell it. But if that didn't work out for me, I could have turned it into an assisted living center, rode out the next 4 to 5 years. I may have liked it so much I wouldn't have changed it, or I may have not liked it, and by the time I finally cleared myself out of the downward trend, I could have pulled them out, repainted, done a couple of touch-ups, and sold it off. So when you're taking on risks like that, you're at different points in the cycle. Understand what exit strategies are available to you, understand how your debt might affect that. The reason I was able to possibly pull that off is, if I'm using traditional financing or institutional funds and the market shifts, I'm not going to be able to go back to Chase Bank, and then I'm just using that for us. And I'm not going to be able to, hey, I understand that the market turned. I know X, Y, and Z. I did a 1-year loan with you, but that's not going to work out. How about we just turn this into an assisted living center and I'll pay you back in 5 years? That doesn't work out. The reason I was able to do that is because up front, I wanted to make sure that that risk was handled. So I used equity to purchase the property versus debt. So worst case scenario, I've still got the equity sitting there, and we haven't lost anything unless we sell when it moves down.
And one thing, and this, not to get too far off the rails, but just to give you ideas so that you do need to prepare for the oh shit moments, is one thing Daniel does that I haven't seen other people do, and maybe it's just because I don't pay attention, is when he's getting private capital, private capital is basically just the same thing as a hard money loan. It's just you don't deal with all the hassles. But he structures it to where, yes, 6 months there's a balloon, but there's also an option to extend. And that's one thing I've never even heard of in the hard money world, is the whole option to extend. And even in a market like this where everything's crazy good and you expect to be out within 2 weeks to 2 months,
it doesn't always happen.
Yeah, be prepared that even in this market, that in 6 months, we might need to extend this thing.
That is one of the nicest things that I like about working with private capital versus hard money. Truth be told, I have yet to use a hard money loan in my life. I've strictly used private capital. But one of the nicest things about using private capital is there's a little bit more of a personal one-on-one touch. Let's say, like whenever I went to do Purdue, and I keep using that one because you brought it up, I specifically told the lender, I was like, there's no way for me to predict what this market's going to be. This particular project is probably about a year-long project. During a year, a lot of things can happen politically. We could drop a nuclear bomb on Korea, and all of a sudden the whole world's up in arms, and we start seeing lending drying up. We start seeing I can't tell you if that's going to happen. So up front, when I took that equity, I straight out expressed that this might occur. But if that does occur and the market goes soft and we can no longer move this asset, we have options. We'll turn it into a assisted living center. But with a hard money lender or a bank, I couldn't do that. So if I'm about to do a flip, I'm like, there's no way I can tell you what's going to definitively happen. But if something does happen, and I can go back to that private lender, I was like, hey, the market just shifted. Even if you foreclose on me and take this property back, you're still going to be stuck with an asset that you never really wanted, that's in a downward moving market, and we're kind of at that oops, oh shit moment.
Yeah, and to be clear,
But to transition out of that, what I'll tell my private lenders is like, instead of let's foreclose and take it back so you can sell it for even less than what you put into it, we'll just turn this into a slightly longer strategy. We'll put it into a rental. We'll move it into a rental. Use that. You can collect 100% of the returns off of that. We'll hold it through this downturn. I'll manage it for you. I'll keep the thing going. You can still use it as a passive investment. It's just instead of it being a 6-month term, we're turning this into a 2-year term, 3-year term. And then whenever the market starts coming back, we can turn around and sell this thing off, and you won't lose any money, and you'll still have that money working for you in the meantime.
And to be clear, it's not like we're shitting on hard money lenders. It's different. Luckily in Dallas, we have plenty of really good ones. You got Chris Jameson, SF Lending, Mike Hanna, InvestMark, Rob Barney
over DHLC,
and the Bay Mountain guys. So plenty of great options, but it's just giving you options out there.
It's my personal preference. Yeah. I mean, if I was starting out and I had 0 options out there other than hard money, I would take hard money all day long. And I'm not against hard money. Most of the private money rates I pay are close and or near hard money rates. The only reason I go with private money versus hard money is the simple fact that the terms can be adjusted, they're amendable, and there's less hoops and stuff to jump through. I mean, it's 2
phone calls versus an application and blah, blah, blah.
Yeah, so it's all good.
Yeah.
I don't know if I've directly addressed everything I was intending to address for the day, but do I have any questions coming in right now about what I'm talking about? While you're looking through that, I guess I can do a real quick recap on the cycles and what.
Yeah, let's do that.
So when you are at the peak or approaching the peak, And you should be doing this throughout your entire cycle, but you should run stress tests on your portfolio to determine which assets would not handle a downturn, and then sell off any of those that would not handle the downturn, or power the debt down so that way it could survive a downturn. Above and beyond that, on the approach to the peak or to the peak, you should be stockpiling as much cash as you possibly can to take advantage of the downturn. Whenever the market does move through a downturn, you need to keep an eye on it and try and time it the best to where you're at the bottom of the market. But as you start approaching and or nearing really close to the bottom of the market, short sales and subject to all day long. Get as many shorts as you can process, get as many subject to properties as you can process, hold those and buy up as many rentals as absolutely possible. Grab all that as you can. Get your long-term holds in when you hit the bottom. And then, like with the subject to, the underlying debt's probably still higher, but you can cash flow that hopefully throughout. If you can't, then start grabbing your subject twos towards the end of the downturn as you're starting to rise back up. But grab as many rentals as you possibly can at the bottom. And then when you're at the bottom, using that cash that you acquired at the peak, ride that out, and on the wave back up, start taking your rental portfolio, once again, moving through, culling it out, rehabbing them, selling them off on the upward market so that way you can capitalize on them. And then throughout the entire upward trend, be flipping, wholesaling, capitalizing, all of that. And then you'll eventually hit the peak again. And as you start getting towards the peak, move back into a capital position and prepare for the next downturn.
Well, I think that you said it. Real quick, where did we get that slide from, just so they get their plug?
We've got it linked in the comments. That was a blog that I read a couple of years ago, and I refer back to quite often whenever people ask me about real estate market cycles and things of that nature. But I believe it is an extremely good article that everybody on here should be reading right now. I think it was CREO Online or something along those lines.
It was written by Ben Ines Kerr.
He's smarter than I am, that's all I can say.
He is a cool slide.
I absolutely know very little. I just pay attention to a lot of smart people.
Right. I just want to make sure that, content knowledge is yours, but we did borrow the slide.
Yeah, the slide was absolutely not mine. That was used from that blog that's linked above. I definitely recommend taking the time to read that. It is going to give you a lot of good information. They based that article kind of on multifamily assets, how to determine what to happen with multifamily assets. Like, Travion, can you throw that slide back up on the screen real quick and see if I can see it? Right there, you're looking at the peak, your net operating income is kind of trending flat, and your price is exceeding your net asset value. Like, what's it gonna cost to build this thing? The price is greater than the net asset value. It'll cost me $1.2 million to build it, but to purchase it, it'll cost me $1.3 million. That doesn't make sense. That's where you start seeing a lot of construction occurring and a lot of construction product hitting the market. As you start hitting the downturn, you're gonna start seeing your net operating income declining, and your property prices are just dropping. As you start hitting the upwards turn, your prices are less than your replacement costs. So if it costs $1.2 million to build it, you can buy it for $800,000. That's where you need to start just eating stuff up. If you're a builder, if you're a rehabber, start picking up your inventory at the bottom. So when you hit the upwards turn, you can be prepared for it. Like, let's say if I'm a builder and I was smart and I got out of it at the peak, when I hit the downturn, I might start going in and trying to buy up the lots that I'm looking for on the upward rise. So I'm prepared for the upward rise. I've got my inventory at the bottom of the market.
Yeah, because if you're buying so cheap, who cares?
Exactly.
So real quick though, like right after you sell after the peak, that's when you have your pizza party, right?
You have the H&B party. But it's all good.
I was going to say it, but it's your company. You can say it. The
No, you do not need to say
it. H&B with pizza.
H&B with pizza. So I think we've wrapped up towards the end of this. Absolutely. I don't see any other questions coming in, so I'm going to call it a day. I hope that I answered your question there. Anna Marie Beats, I believe. My bad if I didn't remember that directly.
Anna Marie Beats.
But show us some love if you enjoyed what you saw today. Please like and share. It helps us get out there. Facebook keeps blocking us over here on this side of the table.
Yeah.
So would you help us by sharing this into as many groups and tagging as many friends as you possibly can? And above and beyond that, always check out Propelio.com. I look forward to seeing you next week on Monday. If you have a specific topic you'd like us to discuss in between, please shoot us a message on Propelio's Facebook page, or if you are friends with me on Facebook, send me a message with a topic you'd like us to discuss. If I like the topic and I feel like I can discuss it for 20 to 30 minutes, I'll go ahead and pick it and we'll go forward with it.
Yeah, speaking of, this was going to be a 15, 20-minute video, but, he puts me up here and I just get all chatty Cathy.
Yeah, but it's all good. So if y'all like what you saw today, have fun. Outside of that, we're done.
What's up?